ready for that meeting and you need to know how companies get valued. Or maybe you're just curious, like, how do those numbers get so big, right?
We're diving deep today into whether valuation is an exact science or if it's a little bit more like art. You know what I mean?
Well, it's so funny because this document you gave me is called Valuation is an Exact Science.
Yeah, pretty bold, right?
Yeah, pretty bold statement.
It definitely got my attention. And, at first glance, it can seem that way, right? Like when you think about valuation, you think about DCF, you think about all those fancy models,
Plugging in the numbers.
the comparable company analysis, and yeah, it all seems very precise, like you're just plugging in numbers.
And you get an answer.
And out pops a valuation. But is it really that simple?
Well, that's what we're going to find out today.
Yeah, exactly.
I think as we kind of peel back the layers here, we're going to see that it's not quite as straightforward as it might seem. Okay, so let's break it down. You mentioned the DCF, the discounted cash flow model.
Right.
Can you explain that to our listeners who maybe aren't financial experts?
Yeah, so imagine like a lemonade stand, right?
Okay.
And you want to buy it.
Okay.
The DCF is basically helping you figure out how much that lemonade stand is worth today by figuring out how much cash it's going to generate in the future.
Oh, okay.
So you got to think about how much lemonade you're going to sell each day. You got to think about your cost of goods, sold your lemons, your sugar, right?
Cups.
Your cups, exactly. Maybe you have to pay rent for a little spot on the street.
Right.
All that good stuff. And then you have to factor in risk, right? Like, what if it rains a lot?
What if nobody likes your lemon
Well,
dog?
people don't like lemonade anymore, right?
Right.
So that's basically what the DCF is doing. It's projecting those future earnings or cash flows and then discounting them back to today to account for the time value of money and risk.
Exactly. So we're essentially saying, okay, $1 today is worth more than $1 tomorrow.
Right.
So we have to account for that. And we have to account for all that risk that you talked about.
Exactly.
So the same principle applies to a huge company like Apple or Amazon.
Yeah.
We're trying to forecast those future cash flows based on things like revenue growth, their profitability, the competitive landscape.
Exactly.
But I imagine that predicting the future of a company, even with all the data in the world, is not an easy task.
Yeah, that's where it gets tricky, right?
Yeah.
Because even with our sophisticated models, we're relying on assumptions about the future.
Right.
And those assumptions can have a huge impact on the final number.
So give us an example, like how much can a slight change in assumptions change the valuation of a company?
So let's say you're trying to value Amazon, right? If you project their revenue growth at 15% a year versus 20% a year, the valuation can swing by billions and billions of dollars.
Wow.
And that's just one variable.
Just one tiny little tweak.
And we've got dozens of these variables that we're dealing with.
Like profit margins, interest rates.
Interest rates, all kinds of crazy stuff.
Geopolitical events, the whole thing.
All of it, yeah. So it gets really, really complex really fast.
Yeah, it makes you wonder if you're ever truly being exact when you're trying to value a company.
It does, right.
It does.
Like, are we just kidding ourselves here?
Right.
And this is something that, even the smartest people in finance have been debating for decades.
I mean,
The source you gave me mentions Oswath Damodaran, who's often called the Dean of Valuation, and he has a really great quote.
oh yeah, I've heard this one. Valuation is not about being right. It's about being less wrong.
Right, and that really sums it up.
Because
It's a reminder that valuation is inherently uncertain.
yeah, it's probabilities, not guarantees.
Probabilities, not guarantees.
We can't predict the future.
We can't predict the future, exactly.
So if we can't be exactly right, how do we even begin to approach valuation in a way that makes sense?
That's a great question, and that's what we're going to unpack today as we go further into this deep dive.
All right, so stay tuned.
Right.
Okay, so we've got this tension between the science part of valuation with all the models and the data, and then the art of actually understanding the numbers and the big picture of the company's story.
Right, it's finding that balance.
Finding that balance, yeah.
And I think one of the biggest challenges with valuation is what do we focus on?
Yeah.
Do we focus on short-term earnings? Are we looking at long-term growth potential? Do we care about tangible assets like factories and equipment? Or are we thinking more about intangible things like brand value and intellectual property?
Yeah, it seems like it would really depend on the company and the industry that you're looking at.
It totally depends, right? What works for valuing a stable utility company
Right.
is not going to work for valuing a high-growth tech startup.
Right. Speaking of tech startups, they often have these crazy high valuations, even if they're not profitable yet. So how does that work?
Yeah, that's a great question. And that really gets into how valuation can be influenced by just market dynamics and investor sentiment.
Yeah.
Right, because sometimes investors are willing to pay a premium for a company that they think has the potential to like totally disrupt an industry or create a whole new market. Think about companies like Uber or Airbnb.
Right.
They were valued at billions of dollars long before they were actually making any money.
Yeah. So they were betting on the future.
Exactly.
Betting that those companies would eventually figure it out, get to scale, and then the profits would come rolling in.
Right. And sometimes those bets pay off and sometimes they don't.
Right. It's a gamble.
It's a total gamble, high risk, high reward.
It reminds me of that saying, price is what you pay, value is what you get.
Oh, yeah, I like that.
So you might pay a high price for a company today based on what you think it could be worth in the future.
Mm-hmm.
But the real value is going to be determined by whether or not it can actually achieve that potential.
Exactly. And it really highlights that difference between price and value.
Right.
Because just because a company is trading at a certain price on the stock market doesn't mean that's what it's actually worth.
Right. It could be overvalued or undervalued.
Exactly.
So how do we avoid overpaying for something that's just hype?
Yeah, that's the million-dollar question.
How do we get to like a more grounded valuation?
Well, I think one of the most important things is to really try to understand the underlying business model.
Okay.
Like, how does this company actually make money? What are the key revenue drivers? What are their competitive advantages?
So we're not just looking at the financials. We're trying to get into the nitty-gritty of how the business actually works.
Yeah, exactly. Like, go beyond the numbers and really understand the operations.
Okay.
And then we also need to think about the market context. Like, is the industry that they're in growing or is it shrinking?
Right. Are there any big trends or challenges on the horizon?
Exactly. And who are the main competitors?
Right. So it sounds like valuation is as much about understanding the big picture as it is about crunching numbers.
It's putting it all together, right? It's connecting the dots.
Connecting the dots.
Seeing how it all fits together.
Okay, so we've got the models, we've got the assumptions, we've got narratives, we've got the market dynamics. Like, what are some practical tips that our listeners can take away from all of this to apply to their own investment decisions?
I think one of the most important things is to be aware of your own biases.
Oh, yeah.
We all have biases, right?
We all have our favorites.
Yeah, exactly. And that can influence how we view a company.
Like if you're really excited about a certain technology or a certain industry, you might be more likely to be like, oh, yeah, this is going to be huge.
Exactly. You overestimate its potential.
Yeah. So we need to try to take a step back from that and be as objective as possible.
Be as objective as possible.
Even when it's something we're really excited about.
Right, exactly. And the other thing is do your homework.
Okay.
Don't just rely on what you're reading in the headlines or what your buddy is telling you.
Right. Go deeper.
Go deeper.
Yeah.
Yeah, read the company's financial statements, research. The competitors really understand the industry dynamics.
Yeah, knowledge is power, right?
Knowledge is power.
The more we know, the better decisions we can make.
Exactly. And remember, valuation is not about finding the one right answer.
Right.
It's about understanding a range of possible outcomes.
Right.
And thinking about the risks and the opportunities associated with each one.
So embrace the uncertainty.
Embrace the uncertainty, do your research, and be prepared to change your mind as new information comes out.
That's great advice. And I think we should probably talk about some specific examples of companies and how their valuations played out over time.
Yeah, I think that would be really helpful to see these concepts in action.
Okay, so let's move on to the final part of our deep dive, where we'll explore some real-world case studies and put all these pieces together. All right, so we've spent a lot of time talking about, how valuation isn't just about finding this one perfect number, like this magic number that tells us exactly what a company is worth. It's more about, looking at all the different factors that contribute to a company's value and coming up with a range of possible values.
Yeah, it's not about being right. It's about being less wrong.
Yeah, exactly. And it's a process.
It's a process, for sure.
It's not just this one-time thing like, oh, we figured it out.
Right, and it's always evolving.
Always evolving.
Because companies change, industries change.
The market changes.
The market changes, exactly.
So thinking about it like a detective investigating a case makes sense.
Mm-hmm.
You're gathering evidence, you're analyzing the clues, and you're trying to piece together, the most likely scenario.
Yeah, exactly.
So where do we even start? If we're trying to value a company, what are the first steps we should take?
Well, I think the first step is to really just try to understand the business. Like, what does the company actually do?
Okay.
Who are their customers? What are their products and services?
So we're not just jumping into the numbers right away. We're taking some time to just understand the big picture.
Yeah, take a step back. Understand the big picture before you start crunching numbers.
Okay, so once we have a good understanding of the business, what comes next?
Then you can start digging into the financials, right? So you're going to look at things like the company's revenue, profitability, cash flow, how much debt they have, all the key financial metrics.
Right, and that'll give you a sense of how healthy the company is financially and like what their track record has been.
Yeah, exactly.
But we talked earlier about how those numbers could be influenced by, accounting choices and
Sure.
different assumptions that companies make.
Right. So it's important to not just take those numbers at face value.
Right, so we have to understand the context.
Understand the context, exactly.
What's driving those numbers?
Right, exactly.
So are we like looking for red flags or inconsistencies or things that might, make us question the company's true financial performance?
Yeah, exactly. You're looking for those clues, right?
Yeah.
That might tell a different story than what the numbers are showing on the surface.
Right. Okay. So once we've kind of analyzed the financials, then where do we go from there?
Then you can start thinking about those valuation models that we talked about earlier. So things like discounted cash flow analysis, comparable company analysis, you can use those techniques to try to come up with a range of possible valuations.
But those models are only as good as the assumptions that we plug into them, right?
Right. And that's where your knowledge of the business and the industry comes in.
Okay.
You need to use your judgment to decide, are these assumptions realistic?
Are they too optimistic?
Are they too optimistic or are they too pessimistic?
Right.
It's finding that sweet spot.
So it's like this constant back and forth between the quantitative, the numbers, and then the qualitative,
Yeah.
The story and the big picture.
It's bringing it all together, right?
Yeah.
It's blending the rigor of financial analysis with the insights you get from understanding the company and the industry.
Right. And hopefully through that process, we develop a more nuanced and informed perspective on the company's true worth.
Yeah, that's the goal.
But even after we've done all that work, valuation is still just an estimate, right?
It's an estimate. It's not a guarantee.
It's not an exact science.
Exactly.
So we have to be humble and recognize that there are limitations to our analysis and be prepared to change our minds as new information becomes available.
Yeah, and I think at the end of the day, the purpose of valuation is to help you make better decisions.
Yeah, it's not about being right all the time. It's about making informed decisions and hopefully avoiding big mistakes.
Exactly.
Yeah. So by understanding the science and the art of valuation, we can hopefully all become better investors.
And, it's something that even the experts, they don't always get it right.
Everyone makes mistakes.
Everyone makes mistakes, and that's okay.
Yeah.
It's about learning from those mistakes and constantly refining your process.
Yeah, it's like a muscle. You have to keep exercising it and strengthening it over time.
Exactly. Well said.
So we've covered a lot today.
Yeah.
I think we've really gotten into the science and the art of valuation.
Yeah.
We talked about the models and the assumptions, the importance of narrative and market dynamics, and just being really critical thinkers, not just taking things at face value.
Yeah, and I think we've hopefully given our listeners a better understanding of what valuation is and how to approach it.
Yeah, how to approach it with a critical eye.
Exactly.
And to all of our listeners out there, we'd love to hear from you. How do you approach valuation? What are your biggest challenges? What are your biggest successes? Share your thoughts, and let's keep this conversation going.
Yeah, let's keep learning together.
Exactly. Until next time, happy valuing.